I've been doing this for over 30 years, and I can't remember a period of time where I've had more investors and individuals ask about gold and silver. And if you zoom out, I think the compelling reason is because last year they had phenomenal returns. So to give some context here, last year gold was up about 63% and silver a whopping 144%. Yet the question really we want to ask is why? And I think it's different reasons. So gold, let's think about this more from a defensive positioning, right? So unfortunately, we're seeing countries across the globe spending way too much money, not receiving enough tax revenues. And so what do? They just print more currency, right? Well, from an individual's perspective, that's not what we want to hear because that increases inflation and that reduces our purchasing power. So institutions and individuals are buying gold really as a safe haven or a hedge. If we go on the offensive position, silver is used in so many things from basically an industrial and technology perspective that I view this as a positive because consumers are demanding it. Rick, think of smartphones, circuit boards, water purification systems, high performance cabling, right? All these things that we want as consumers. And so silver is going up for a positive reason. So it's kind of a unique situation where both are positive, and both have volatility. So I do want to mention that if I may. So again, we love upward volatility, but let's remember that it also can have downside volatility. And year to date, Rick, both gold and silver are down and very volatile. So I just remind our clients and investors, a saying I like to use, pigs get fed, hogs get slaughtered, right? So we just want to have a balance here within your overall portfolio construct. So it's good to own it. They're great diversifiers, but just balance, balance, balance. All we have to do is look at the fourth quarter of last year, right? And so when we go back to last year, GDP, we're seeing estimates in the fourth quarter that were between 4 and 5%. And what we're now hearing is because of the shutdown last year, I think 4% is the number we should probably anchor on for the fourth quarter of last year. That said, still a great overall GDP. I think we'll get a 3% for the entire year. We'll take that. But there's a lot of momentum going into 2026, but it could be derailed for the things you just talked about, another shutdown. So I think what I would tell our investors and our clients is that, we can't do predictions on tail risks, shutdowns, terrorist attacks, pandemics. We know those do happen from time to time, right? So we may get another shutdown and that may slow down the overall GDP, but I'll tell you right now, the GDP numbers that we're looking at for the entire year are really positive. So this could be a speed bump along the way. And then we think about inflation. Once again, kind of touched on a little before. Look, the inflation trends are there, and it's you want this Goldilocks inflation, not too hot, not too cool, just about right. So I know the Fed loves to have like a 2% inflation rate. I'm not sure if that's reality. I think 3% is something that we all could really accept and live with because that means right where the consumers want more things, wages are going up, and overall that's kind of a nice balancing act. So we see 2026 as a pretty positive year from a GDP perspective. I think overall, inflation, we may see some inflationary trends, but I think the 3% number is a realistic number to expect.